Good afternoon, everybody, and welcome to Overrated, Where Next for Fundamental Business Rates Reform. My name is Jon Fletcher. I'm Director of Finance Policy at the British Property Federation, the trade body representing investors in UK real estate. And as many of you will know, the government is currently in the middle of a fundamental review of business rates. It published yesterday an interim report summarising the responses it received to a consultation it ran last year. And we're going to spend the next hour or so just thinking about the background to this huge issue, some of the challenges and the problems with rates, some of the comments made as part of the fundamental review, and probably most importantly of all, what some of the solutions might be. How might we move on from where we are now? So we want this session to be really useful to you. And so please do use the Q&A to share your thoughts and questions, and we'll do our best to tackle these as we go along. So a small technical point, we have both Q&A and chat at the bottom of this Zoom webinar. If you could use the Q&A function in that way, everybody on the event can see the question. Otherwise, I think it's just us panelists who can see that. Now, to help us navigate through these topics, I'm delighted to be joined by some excellent panelists who I will now ask to introduce themselves. So if you could just say who you are and who you work for, and very briefly, your interest in business rates. And we'll start with David.
Thanks, Jon. Yes, my name's David Shepard. I'm Director of Professional Services at Bruntwood. We're a family-owned investment and development company, particularly specialising in the office and life science and technology sectors. So as an owner, our key interest in business rates is particularly around empty property rates, but also the impact that business rates has on all our customers across our portfolio.
Thanks, David. Jerry.
Hi, everyone. Good afternoon. I'm Jerry Skirder, Head of Business Rates at Gerald Eve. My interest in business rates is in seeing it reformed before I retire, having spent the last 40 years of my life at Gerald Eve advising business ratepayers, owners and occupiers. This really is the time for reform. Let's get on with it.
Thanks, Jerry. John.
Hi everyone, I'm John Sigler, I'm Head of Property at River Island. I guess my key interest is we pay a large amount of business rates and we think it's an unfair system and we're overpaying considerably, as do many other retailers. I also sit on the PMA committee, which represents high street retailers, so we also know full well that all other retailers feel the same.
Thanks, John. Kevin.
Yeah, hi everybody. Kevin Hollingrake, Member of Parliament for Thirsk and Malton, which is in most glorious parts of North Yorkshire, and MP since 2015. Most of my life, though, I've been in business. Grew an SME from a small business to a larger national business. So we were paying lots of business rates. I've sold that business now, so I'm probably free of conflict. But even when I had my business, I was believe that business rates is anachronistic. You know, it's made for another time and it needs fundamental reform. Most of my work in politics in Westminster is trying to support SMEs and give them more than an even chance of fighting out with the big guys. And I think this is one of the areas that needs reform to help them do that.
Thanks, Kevin. And Vivian.
Hello, I'm Vivian King, formerly CEO of Revo. I've had a career in commercial real estate, and business rates has always been on the agenda, whether I've been a consultant or an owner. My current interest is chair of the Shopkeepers campaign, campaigning for the reform and reduction of business rates.
Great. Thanks, Vivian, and thank you to all of our panelists today. A special thanks to John, who very kindly stepped in at the last minute yesterday when one of our other speakers had to drop out unexpectedly. Let's get stuck in. It's of course welcome that the government is committed to a fundamental review of business rates, but Jerry, we've been here before, haven't we? I mean, most recently in 2015, when the government carried out another such review. Whatever happened to that, and what, if anything, changed as a result?
Well, that review, which, as you say, was pretty recent, brought very little change, certainly so far as larger businesses are concerned. The key change was that the small business rates relief scheme was made a permanent feature of the rating system, and the benefits were extended. That was really the principal measure brought in from the 2015 review. And otherwise, all the government committed to was to in future undertake revaluations more frequently. which it decided would be every 3 years starting this year in 2021. But it failed to pass the legislation which was necessary for this, and it's now dropped the commitment, leaving frequency of revaluations to be determined as part of the current fundamental review. And of course, as a result of COVID, the government has postponed what was meant to be the 21 revaluation to 2023, and rates bills until then are going to continue to be based upon property rental levels as they existed pre-Brexit, pre-COVID. Makes no sense at all and is manifestly unfair.
Well, absolutely, and clearly the world has moved on an awful lot since 2015 and since the last revaluation, and so has the way that we use commercial property. You know, that's something that we've all noticed over the last year in particular. But I mean, John, if I could turn to you, how has River Island's perception of, you know, the value of physical stores changed over the last few years? You know, what's changed about the way that you use premises and view them, and what impact has business rates had on that?
I mean, well, I'd say that, you know, the bricks and mortar estate that we have is still very fundamental to the success of our business. Pre-pandemic, it was about 70-75% of our turnover. But on the flip of that, our online business and our wholesale business was taking large chunks of that every year, basically. We thought it would potentially level out nearer to 50-50 at a certain point in time. Whether the pandemic's accelerated that, we'll have to see. But the stores will always be part of that business. You know, the web business and the store business are connected in some way, shape or form. But where I say rates is, you know, I do all of our, you know, our acquisition works, and it, as well as sort of managing the estate, you know, it is becoming the biggest decision driver, whether we keep a shop, whether we close a shop. It's not the rent anymore, it's the rates and potentially the service charge. And also, I found it frustrating where we've tried to potentially, you know, upsize a shop. It's the rates that's basically stopped that from happening, because they are just so overinflated from what they should be. And it's a massive challenge that I feel the system not only is obviously overinflated for retailers especially, but also the relief systems are an incredibly negative system. It doesn't create positivity or entrepreneurship. It actually stifles growth. It encourages people not to change their business. I think that's something that we really need to challenge, you know, and it's also not a very green tax as well. If you look at things like improving your energy efficiency, a lot of that would come under rating, you know, that would become rateable assets. And so where's the encouragement for businesses to become green and more energy efficient in that?
You know, a really good point. And actually, I mean, that's already partly answered, I think, one of the first question that we've had. Thank you very much, Roger, for that. I'm sure we'll pick up more later on in terms of the relationship between business rates and incentivizing sustainable development, sustainable retrofit, which is going to be a huge part of helping us meet our carbon targets. Now, you know, we've already started picking up on some of the issues with business rates, and ahead of the last budget, 45 Conservative MPs, mostly representing northern constituencies, wrote to the Chancellor calling for a cut from 50% to around about 35% in business rates. Now, clearly there's at least a perception that there's a big regional dimension here to the challenges of business rates. And Kevin, I was wondering if we could get your take on this, and how have you seen business rates affect businesses in your own constituency?
Yeah, I mean, I can say I agree with everything Jerry and John said, you know, particularly on how business rate stifles investment, which is kind of the worst ever thing. You know, it's, you know, I always said business doesn't need empowering, it just doesn't need disempowering. And too many things we do in government for generations disempowers businesses and makes life more difficult. I mean, yes, of course, everybody sees it'd be great just to cut business rates. What are you going to replace it with, though? So 50p multiplier down to 30 odd p, great, third off your rates bill, but that's 10 billion quid. And we're already not balancing the books, and haven't been for 5 years out of 35 we balance the books in this country. So we've got to replace it with something. So yes, absolutely concur with those who want to reduce the burden of business rates and make it a much more fair and level playing field, much more dynamic. But the trouble is, as Jerry said before, that every time the government looks at this, he looks, my God, that's got to go on the too difficult pile, because either you tweak it a little bit, which will make it more complicated, or you revolutionize it, can fundamentally change it, which is always risky. So I think the big thing I would say about all this, and as you know, some might know, I put forward a private members bill, a 10-minute rule motion to completely scrap business rates and replace it with VAT, an increase in VAT, because that immediately levels the playing field for everybody. And at the same time, we should lower the VAT threshold. We might as well throw the whole thing in and get it sorted out now, because that's another inhibitor of investment. But business rates were built for a completely different era, when trade was property based. And we're now looking at online sales tax, which seems to be the Treasury's favourite option, which only really tackles a retail problem. Yet in the consultation, in response to the consultation, the government yesterday acknowledges that actually it's 100 billion quid with the retail sales online, but there's 700 billion altogether stuff done online, trade online. So if you do the retail stuff, you're only going to fix the retail problem. What about the pubs and restaurants that get in trouble getting competition from dark kitchens? What about estate agents that get in problems from online estate agents, travel industry, all these different things? So you're just going to make the situation more complex. It's too complex already. All the reliefs, all the revaluations, all the appeals, and you can add an online sales tax on top of that, which me as a retailer, I've got to decide, well, did I sell that through my store? Did I sell it through Click and Collect? Did I sell it online? It's just going to make it more complicated. And so that's kind of my kind of thing, but fair and level playing field. Ronald Reagan once said, there are no easy solutions, but there are simple solutions. So it wouldn't be easy to fundamentally scrap the whole thing and start again, but that's, I think, exactly what we should do. And that makes it fair and level, the playing field fair and level for SMEs and for big businesses.
Can I just come in on one point there?
Yeah.
It is absolutely the case that the current rating system, especially for retail, does more than anywhere affect the north more than the south. That the transitional scheme definitely affects, you pay more in the north to fund the south. Basically, that's just a reality. And I say that as a Londoner, that's just the truth of it. And so it is an inherently geographically unfair system as well. But I think the other point is about, is it relevant to the world of business anymore? And it just isn't. I think everyone would agree with that. And if we want to have a fair and relevant system, it has to look at the value of that property to the businesses in it. Whatever that business does, that's got to be the core message around it, I think.
Thanks, John. And let's get a property investor's take on this. David, I mean, you're based mainly in the Midlands and Northwest, so clearly you'll be feeling this regional pinch as well. But I mean, how does it disempower you, to borrow Kevin's language, from what you know, your goal of creating spaces where work and lifestyle thrive? And I've borrowed that from your website.
Yeah, I mean, certainly it's creating thriving cities is our strapline, and to do that, there's a lot of placemaking involved in that, and that's working with a lot of independent retailers to get the right mix of people within our schemes to make sure it draws in the footfall and makes them vibrant, interesting places that people want to visit. So for those sorts of businesses, often new and maybe new enterprises that are trying to set up, the actual burden of business rates for them is significant. Obviously, there's small business rate relief which can play in. However, I think the way in which the system has progressed since it came in its current form in 1990 is it's effectively been distorted out of all recognition from true property values being the basis of the tax, because it feels like reliefs are introduced to stop the impact and cushion the impact, and that's left as John has just explained in terms of the way in which the geographical imbalance has come about, I think. So going to a place where this is supposedly a tax based on property value, we're far from that. And as Jerry said, the delays in revaluations only obviously brings focus to that point, given all the macroeconomic issues we've had since the last reval. So that has a great impact on our customers and obviously their overheads and what they have to pay. From our perspective, in terms of a developer and creating interesting places then empty property rates is a key issue for us. The ever since the empty property rate relief, which was at 50%, was abolished in 2008, it means that it's going to stifle investment, because we have to take that into account on all development risk decisions we make. Whether it's we're repurposing an existing building or we're bringing new products out of the ground, we have to have an eye on what the rates liability is going to be before they're occupied, and that can only inhibit the ability to make bold decisions, which really is going to drive the economy in terms of investment happening. So anything which disincentivises that is clearly not going to help, and particularly at the moment when we're obviously all looking at recovery from what we've suffered over the last 12 months.
Yeah, absolutely. And Vivian, what do you see as some of the big issues with rates, and what's the rationale behind the shopkeepers campaign, and what prompted its launch last year?
Well, I suppose the first thing I'd say is that we are supportive of a property tax per se. It just needs to be fair to all, and the system we've got isn't. And just by way of example, the rates payable by retail have increased 87% since 2001, whereas rents have only increased 17%. So clearly that disconnect that we've been talking about is fundamental. For a tax that's supposed to be pegged to rental values, it's just not. And that slow pace of revaluation is the culprit there. So that's one of the big issues that we've got to address. The cost, fundamentally, the multiplier at 50% is just way too high. It's higher than any other European multiplier. It makes us uncompetitive. It disincentivizes investment. I'm sure we'll talk about that more. It's extraordinary. So that's really got to come down. We've suggested it comes down to 30p in the pound, simply because that brings it closer to where it was when it started. But when it started, of course, we weren't in a world of online, and we're looking to compensate to a degree for that in the retail environment. But we consider 30p to be fair. Interestingly, in the interim report, I see that some were asking for 25p. I think the message is that there's got to be a dramatic reduction in the multiplier. It is hopelessly complex, given the range of taxpayers who are paying rates. To be presented with such a complex system to navigate is unforgivable, and it is archaic. The way it's managed is archaic. I know that there have been government commitments now to invest in the Valuation Office Agency, which is great. We've yet to see how that's going to pan out. But the whole thing just is sluggish and discourages investment. So those are the big issues so far as the shopkeepers campaign is concerned. The rationale was really very simple. We were invited for a view. We saw those defects, and we put forward a view on how they could be resolved. I've talked about the UBR. It needs to be fairly priced. It needs to be fairly operated, so that you have annual revaluations that are at least some way close to rental values, and do away with downward transitional phasing, because yes, as we've talked about, that really does penalise the Midlands and the North. Empty rates relief at 3 months is just shockingly inappropriate. And we also wanted to make it very clear that coming up with a capital values tax was not the answer to this. It simply shifts the pieces around the chessboard. But I suppose part of our rationale also was to come at this also from a sort of grassroots perspective. So we really wanted to be influencing and listening to those who could influence and those who were subject to this tax right the way across the piece. So we've been engaging with owners, we've been engaging with retailers, members of the public to explain the impact on their town centres, MPs, peers, councillors, because we felt it was really important that government understood the depth of the resentment felt by the business community in relation to business rates as background to this reform. So our messages have been really very simple: save our shops by cutting the rate and making it simpler, and let shops help save town centres.
Thanks, Vivian. And you mentioned valuation, which is also actually one of the questions that's been asked. Thanks very much for your questions. Do keep them coming. So I'm going to pick up this question, which is around: is there a problem with how property is actually valued for business rates, or how the tax is charged? And obviously, rental models have changed quite a lot over the last 5 years. This is particularly the case in high street businesses. And John, you might have views on this, but I'm going to turn to Jerry first and ask: how well set up is business rates to deal with different types of rental arrangements that aren't your traditional 5 or 10 year lease with a fixed rent?
There are some significant issues around valuation and rental evidence, and we may see those in the future more in relation to the retail sector, when we are talking about a move away from fixed rent, long leases, to shorter leases, turnover related and footfall related and the like. I've actually got a far more immediate concern, which is the valuation date for the 2023 revaluation. Until now, there's always been a 2-year gap between the valuation date and those values coming into force for setting rates bills. And so therefore what that means is that the 2023 rateable values are going to be based upon property rents in the market next week, on the 1st of April. And government continues to claim that the VOA says it can value accurately on that date. But given the almost total absence of any new lettings in recent months, especially in the retail sector, but not only, I mean, how on earth will it be possible to justify those new valuations? And many of us have been lobbying to put back the valuation date either to the 1st of October of this year, by which time hopefully we will have at least started to emerge from the worst effects of the pandemic, and there may be some evidence created in the market, or preferably the 1st of April next year. I mean, looking longer term, looking to the future, in any event, we should never continue this 2-year gap. It should be a 1-year gap as a maximum. And to their credit, the Scots have already announced that they've adopted the 1st of April 2022 as the valuation date for their revaluation 1 year later in 2023. So it can be done, and I have huge concerns about the potential quality and the accuracy of 2023 revaluation based upon rental values next year. Looking a little bit further ahead, perhaps, and in terms of when there are transactions which are more turnover related, and new formats for leasing, I think it's fair to say that the rating system and valuers have long had to address changes in the market, leasing trends. And whilst it's true that turnover related rents don't fit the statutory definition of rateable value easily, I don't envisage insurmountable problems. We will be able to obtain a reasonable estimate of a property's rental value, one that will be perceived to be fair, particularly if we do have the frequent revaluations that so many of us are asking for.
Thanks, Jerry. John, what's your take on that, and your thoughts also around how we get to more frequent revaluations?
I think from an occupier's perspective, I think our number one issue really is that what was announced in the budget by the Chancellor was just not good enough in terms of protecting the businesses going forward this year. Obviously in Scotland and Wales, and I think Northern Ireland now, they've extended by 12 months, which gives us breathing space. But we've had 9 to 10 months of basically no trade. And whilst we've been able to sort of talk to landlords and deal with that as much as possible, we've got to think that we are going to be able to open the doors on the 12th of April and get back to normal is just a fantasy. And it's really concerning that the Chancellor doesn't see that. And what I think also, I totally agree with Jerry, like, how can you value something on the 1st of April? It's chaos out there. And so anyone who can tell me what a tone or a zone A rate is on a high street, I think they're not telling the truth. But I think the other thing I'd say is that annual revaluation, certainly for the retail sector, is just a must, because a deal that you use, a re-gear or a lease renewal or rent review, whatever it might be, that you do 6 months ago looks out of date now in this frame. That's how quickly the market's moving. It's also going to move more towards turnover-based rents. That's just inevitable. There might be low base rents for turnover top-ups, or it might just be pure turnover-only rents. How do you value that based on the current legislation? You can't without having to get turnover information from the tenants, because how can you say how much rent they paid? That's really a challenge that I can't see how the VOA can deal with without changing the legislation. How can you go to annual revaluations? You make it a digital tax, for starters. It's not that at the moment. I always think it's ridiculous. I walk past my my administrator's desk and she has piles of these requests for information forms that have come through from the VOA, and you just think it's not very green to start with, and it's just it's archaic. It's like the 1980s all over again. And we have all the information that the VOA require to make their assessment, if you like, with my criticism and questions about how you do turnover rents, especially on the side. Why can't we just upload that information in one go and update it as and when we need to? I think that's the obvious way forward here for openness and transparency. My concern there is a little bit around the attitude of the VOA in the past. And if you see it, you've seen what happened has come out recently about how they've basically stepped away from negotiations around MCCs around office space. It feels very protectionist. It feels like they're not out there to try and actually achieve what is the right level of rent rates. They're there to protect the income, which feels a little bit like reverse tax avoidance to me. Doing everything you can to actually not make someone pay the right amount of rent, even though it's fully justified. And that seems to be what's going on at the moment, and has been going on for quite a while, really. The levels and barriers they put into actually putting an appeal in, or to actually justify appeal, it's really bureaucratic and it's really time consuming. Whereas it really should be about, yeah, you're right, we've got it wrong here, we'll adjust it. And that's definitely not the attitude that you get from the VOA. It's very protectionist. So for us to work together, which I think is what we're all talking about doing, there needs to be give and take on both ends. There needs to be give from the occupiers in terms of information and data and communication. That's via our agents, and there needs to be an acknowledgement of the VOA that their role is actually not to protect the income, but to actually make sure the list is correct. I think that's the key things I would say going forward. Thanks,
John. I mean, you mentioned there a digital tax where you just report when things need to change. So a view from the panel, maybe starting with Vivian. Business rates as a self-assessed tax, like most other taxes in this country?
I think it's a nice idea, Jan, but and perhaps you could have something that is reflective of rents paid and it is self-assessed on that basis. But I can't help but feel that government's going to want to keep control over this and keep the NAO involved. And it's a nice idea. I just don't think that they're going to relinquish control of it in that way.
Okay. One of the questions that's popped up is going back to the valuation point. To what extent will the VOA be taking CVA rents into account when they do the next reval? Jerry, that's probably one for you.
We, the VOA, take all relevant rents and all relevant evidence into consideration when preparing our assessments. I mean, I just don't know the answer to that question. Clearly, CVA rents do not fit the statutory definition of rateable value, but it has to be the case that they are very good evidence of what an occupier has been prepared to pay in order to continue trading and occupying space. So they must have, in my mind, considerable weight. I suspect that the Valuation Office Agency will probably want to ignore them, even though they may be the only evidence they've got available to them.
Thanks, Jerry. Moving on a bit then, just picking up some of the other issues that were in the fundamental review last year and some of the other suggestions that were in that consultation document. the government did consider the potential, kind of put out there for exploration and comment, the idea of more tailored multipliers. So rather than having a uniform business rate, you might have a multiplier that is based on the geography, where the building is, what type of building it is, what value that building has. Kevin, your thoughts on that suggestion? I mean, it potentially could help with the regional issue.
Yeah, I mean, every time you look at this, I've said before, the trouble with all this is that it's not that the government's wedded to any one particular solution. It's not wedded to the Valuation Office Agency, which I agree is at the moment not fit for purpose. It's just impossible to get a good service out of the VOA. But it's wedded to the 30 billion quid. It needs a 30 billion quid. So whatever you're going to do, you're going to bring some money in from somewhere else. So you're going to change the multiplier somewhere. It's got to go up in somewhere else. And I can't imagine one of John's stores in central London is going to be pretty keen to pay more in terms of business rates. So it's got to be cost neutral. And the difficulty with this, of course, the more reliefs that come in, the more the burden is shared between fewer people. So it's really is, again, it's, I'm a massive advocate of small business because I think that keeps us all on our toes and drives prices down, service up, and I think we all agree with that. But so at the moment, you've got this unfair situation where some people aren't paying business, aren't contributing, and some people are, and that's, to me, not right either. It should be a proper, fair and level playing field. So anything that gives rise to more complexity in this is things get worse. So I don't want to see it get worse. I think one of the other issues you try and tackle here is that you've got this K-shaped recovery, as lots of people refer to it. You've got some winners and losers in this whole space. So it's not like every business has suffered to the same extent from COVID. Actually, some businesses have done really well because of COVID, and some trends that were already in train have just been accelerated through this. Obviously, the most obvious one is the move to online retail sales. So inevitably, there's going to be some washout. There's some businesses just won't survive. I think 180,000 jobs last year in retail, I think alone went. So we'll picked up elsewhere. So we can fiddle around the system for ages. We can put some reliefs in here. We can change the multiplier there. We can do all those things, and still the system won't, in my view, won't be fit for purpose because it's about a different time, as I said before. So panel, I think Jerry and others and John and Vivian talked about turnover related rents. Well, okay, well, why not turnover related rates then, which is VAT, and that's the easiest way to do it. You can make a complicated way forward, and I know lots of people on this call will be people involved in the rating sector, which won't be really pleased to think there won't be any rating of buildings anymore. But I mean, again, in the consultation, if you read it, some people quite rightly say, okay, if we have an online sales tax to solve this problem, then I'm going to be paying as a retailer, and actually it's going to reduce the multiplier across the board, and people who don't pay that is going to get some discount off the rates. How can that be fair either? So I have real sympathy with the government on this, in that they get criticised, they keep doing these reviews into business rates and keep putting it on the too difficult pile, because it is difficult. It's difficult to tweak it. It's much easier to scrap it and start again, which is my rather simplistic solution, perhaps, that some people will call it simplistic, but I think is far more fit for purpose. If you imagine a new world where you're putting 3p on VAT and everybody's paying it, and of course consumers paying it, but consumers pay all taxes, and then you've got this wonderful fair and level playing field. It doesn't matter if you trade from a store or you trade from a dark kitchen or your back bedroom or whatever, everybody's paying the same amount, and it creates the conditions then for a really dynamic economy and encourage people to invest in their premises, which is exactly what you want. And at the moment, you put air conditioning in your premises, you pay more rates. It's bonkers, and plant and machinery. It's just totally the wrong way, and inhibits investment in our economy at a time when we really need businesses to invest in our economy to generate more economic activity, to generate more tax. We've got some, and the money we put into, because of the Chancellor's put in because of COVID, 400 billion, is going to be dwarfed by the future costs we've got to pick up for adult social care, healthcare, pensions. Fortune coming down the road in terms of X. If we all want to pay lots more tax, then that's what we'll have to do. If we want to make the economy more dynamic, make it grow more quickly to pay for all these huge future costs, then let's start actually reforming the way the economy is, the framework of taxation in the economy, which I would like to see.
Thanks, Kevin. It's worth noting that in putting together this panel, we did try very hard to find someone who would defend the status quo on business rates. Utterly failed at that one, but I think it's rather telling of where we are. We're going to move on to solutions very, very shortly. Just before we do, Jerry, there's one of the questions that's popped up in chat rather than Q&A is that other major countries with similar systems have different multipliers for different types of properties. Do you see that as something that would work here in the UK?
I think it would work if we had the same levels of tax rate as other countries have. We would not be here having this discussion if we had a 5p UBR instead of a 51.2p UBR. There are many solutions that are achievable and a much more acceptable level of tax, a much more acceptable taxation system if everybody pays less. We can compare our system most closely to that in Hong Kong because it was based upon the UK system when it was invented. They have annual revaluations. They have a 6-month gap between the valuation date and the assessments coming into force, and the system works swimmingly well. But yes, they've got a tax rate which is about 10% of what we pay here. So there are lots of solutions, and alternative multipliers would probably work in that sort of scenario. Self-assessment might work in that sort of scenario. But when we have a tax, which is the highest comparable tax in the world, then of course businesses going to want to look very, very closely at those taxation levels and will want to make sure that they are fair and representative. I'm not a supporter of different levels of uniform business rate. There are many reasons to try and avoid it, mostly because of the complexity that there already is within the system. We could address quite a number of the challenges that we have through a lower uniform business rate. And I appreciate Kevin's absolutely right that government needs the revenue. But I think the discussion that we're having at the moment and we are having through this fundamental review is how do we make the business rate system fit for purpose going forward? And I would say that whilst I'm not a supporter of the status quo, I am a supporter of business rates. And indeed, as Vivian indicated, so was the Shopkeepers Forum, as was the British Property Federation and John's Property Managers Association and the CBI and the Federation of Small Businesses and British Retail Consultation. They are all supporters of a property-based tax. Most modern, if not all modern economies of the world have a property-based tax. But what has to happen is that it has to be set at a fair level and administrative appropriately so that it is responsive to economic performance. Yes, that would lead to a shortfall in revenue, but that is an issue that government needs to address. And many have ideas as to how that would be, either through existing forms of taxation or through alternative, new methods of taxation. But if we're going to look at business rates and addressing that, and really that is the focus very much of this government review, there are many steps that can be taken, firstly starting with a reduction in the UBR, but then the administration, so that actually we will be left with a sustainable property tax system going forward, and we won't need to have continuing reviews to try to address the issues.
Yeah, absolutely. Well, moving on to solutions, then one that has garnered quite a lot of profile and that we understand the government is quite interested in. Kevin's already mentioned it is an online sales tax. There's very little detail given either in the original consultation published last year or in the interim report published yesterday, 2 days ago now, as to what this would look like or do. John, your thoughts on an online sales tax from a retailer's perspective?
I think it's an impossible question to answer without knowing what's going to happen to business rates. I think it's what most retailers will say is like, no retailer is going to want to advocate a situation where they could end up paying more tax just because the way that they trade and the way they do business has been fundamentally changed, which is obviously what's going on. I think what Jerry says is true. I think what we're looking for here is a fair and sustainable tax, which we just don't have at the moment. I feel there is a halfway ground that is possible for the retail sector. I think that's another point. We at the moment, we definitely look at this as a retail problem, business rates, I think, and it fundamentally is. I don't know enough about other sectors and how they feel about rates to have an opinion of it. Ultimately, we are in a position where it is having such an overarching effect on our industry that it has to be changed. And therefore, could you look at a situation where you just change it for the retail sector, where you acknowledge that the way that business is done in the retail sector has fundamentally changed, and therefore the value of a property, depending whether it's an ASOS distribution warehouse or a River Island shop in Grimsby, it's a different value now than it was before when the business rate system was set up to look at that. And is there a hybrid model, which essentially is where you can see, certainly in certain circumstances, rents moving to, where you have a low base system, so a base level which the government is guaranteed, well, not, that might be 10p in a pound, whatever it might be, and on top of that there's a turnover top up, which is the digital bit of it, and therefore you'd have a fairer system where the tax is actually, the actual ultimate tax is based about the value of that property to the business. It acknowledges there is a value of the property, to the business, but it's actually really what do you make from that shop, or from that warehouse, or from that office. That's where the tax actually sits. I think that's how I could see retail working. I don't know if that would work for any other sector, to be honest, but I think that hybrid model is possible. An online sales tax itself is, I think, an incredibly difficult thing to understand how it could work, because it's an international thing. If you look at Amazon, yes, you buy products from Amazon directly, but you also buy products from exporters in the Far East, exporters in America. How are they paying tax? Because they aren't British companies. So how do you make that work? But ultimately, I think it's a very complicated and difficult way to see how it could work without an international position basically being agreed, which I don't think is going to happen anytime soon. Ultimately, businesses like retail businesses, we need help now. We need clarity now. The government needs to do something now around reducing rates to a sustainable level as a sort of stopgap, I would say. And then if they really think online tax is the way to go, they need to talk to us about how it could actually work and how they would change physical property tax at the same time. Again, it also comes down to how can you incentivize someone to have more stores? We've got plenty of good online retailers in this country that have absolutely zero incentive to open shops as well. Where's the incentive to go through the hundreds of thousands of pounds of fit out costs, the legal process, which is mind-bogglingly complicated compared to other countries as well, or to pay an overinflated amount of tax? There's no incentive there for other businesses to grow and diversify into bricks and mortar and to improve our high streets. I think that's a real issue with it as well.
Thanks. And David, I mean, what would your non-retail customers think about a business rate solution that was just focused on retail?
I think it's, certainly it's a sector which, because of the way it's evolving and changing and expanding the different forms in which retail is happening, it's rather than throwing everything, the baby out with the bathwater with everything, it does seem maybe a place to start in terms of concentrating on that sector, because it is changing so drastically. I think the key issue is that the neutrality that business rates has to be in terms of this absolute red line, if you like, that whatever happens, we always have to collect the same amount of income. So if anything, that is the prohibitor, which I think possibly if that was released and we look at this like any other tax, I don't think that is the case with any other taxes that any of us pay through any other form. So if that wasn't in place for business rates, then that might allow for the creativity to come up with solutions which ultimately, and what all ratepayers or taxpayers want, is fairness and certainty around what they pay. So I'd say that would certainly help, and whether looking at the retail sector in isolation as a way of just trying to find fairness there, without that need to collect a certain amount.
Yes.
As you say in the question, from others in non-sectors, I think we'd watch that and hopefully support that for people in that sector.
Thank you. And one of the other alternatives that was briefly explored in the government's review is to replace business rates with a capital values tax, which would be payable by property owners. Vivian, you mentioned this earlier in your intro. Why would that be a bad idea?
Because it doesn't change what needs changing. It just alters who pays. So we've talked about the fundamentals here that are broken, and you can't gloss over that simply by altering the responsibility. It's that simple.
And one of the things, so former Treasury Minister David Gauke was on one of our panels a few weeks back, and he told us that, you know, on the subject of business rates, one of the pushbacks that officials would always give against cuts in business rates is that if business rates fall, then that just means that property owners can increase rents. And so businesses would not ultimately be much better off from where they are now. What reply would you make, Vivian, to that argument?
Well, I think frankly, it's fundamentally misunderstanding the nature of the market. I mean, John's been talking about the disincentives for people coming into bricks and mortar, tax being part of it, fit out costs, legal system, etc., etc. So that sort of comment it bears no reflection on the challenges of letting in a difficult market, where incentives are necessary to draw people into bricks and mortar, as opposed to piling in more barriers. So if you lower business rates, you help that process. You draw people into town centres. You start to create a dynamic economic environment. If investors then go and increase the rent, they just put it all back where it was before. So you have no letting. I mean, I think one thing also to always bear in mind is that rents are negotiable, rates aren't.
Absolutely, and I think the other point I'd certainly make and do make in conversations with Treasury is that about 50% of commercial property is owner occupied. So it's not all about property owners. It's also very heavily about owner occupiers, many of which will be the SMEs that Kevin's very keen to support. And with that, sorry.
If you don't mind, I'll just sort of jump in just to add some comments, because I think that this is an argument that I've heard for many, many years, probably decades, whenever the issue is flagged. I think that if we adopted the solutions that have been tabled, John talks about annual revaluations. David says we must fix, the UBR so that it doesn't always have to adjust to ensure fiscal neutrality. If we had revaluations each year, well, there'd be no incentive for a tenant to pay a higher rent because his rates had been reduced down to our 30 or 35%. Because if he did, he would know as night follows day that in the year ahead, his rates bill would go up because his rent would go up to reflect his rent has gone up, and therefore his rates bill will go up. So we're never going to reach agreement as to whether capitalization will occur, and if so, over what period and how long. But actually, it becomes an irrelevance if we have the solutions of fixed UBR and annual revaluations.
Or if we do away with business rates altogether, Kevin, as you've already suggested. And I wonder if we could come back to that option. You've already spoken about the whys. I'm keen to understand what feedback and reception you had from other members of the House and indeed the government, and what kind of engagement they've had with you on that.
Yeah, pretty good actually. I mean, there's no doubt it's radical, and I mean, you said before, that you couldn't find anybody to defend the current system. I will defend it. actually, it brings in 30 billion quid. And actually, most of the decision, and this sounds very kind of callous, but we had a couple hundred stores around the UK. Most of the decisions you make when you open your store, your spreadsheet, you put the rates line in, and you're going to pay it. I think what's happening at the moment is this rapidly accelerating change in the economy at the midpoint in lots of leases. So they think, my God, I can't do this anymore. Consumers are going in a different direction, which is what's driving the problem, actually, not the business rates. Consumers aren't buying as much from retail stores. So, but over time, the business rate system will probably iron itself out and probably okay. But at that point in time, our high streets might be devastated. That's the biggest issue we've got here. So if we've got to keep the 30 billion quid together. The Treasury's never going to go to something where it's only going to get 15 or 20 billion. It's never going to go there. We've got to replace it with something. So I think what the government's saying in its consultation is three options, really, it comes down to. Capital values tax, which I agree is, again, pretty radical, and nobody can quite see that's going to be much better. It does mention increasing VAT, which I'll come to in a second. The online sales tax. I think online sales tax is the least radical option. It's kind of like the status quo. And in terms of John's point, what it to do roughly, let's say it bring in 7-8 billion quid a year from retail, and with that, and some of that from places like Amazon, and that would be then used to reduce probably a multiplier on resale premises. Jerry will probably understand more, but that's the only way I can see it probably would work. You'd have a different multiplier for retail premises, which means John and Vivian's bills would go down in terms of their retail premises, and they see a benefit there, nevertheless paying some online sales tax if they're trading online as well. So I think that's pretty much where it's going to head. I don't think that's right. I don't think it's suitably radical. I think we'll still see the devastation on the high streets with that solution, because as I said before, this is not just about retail. There's lots of sectors that are being affected by the transition from a physically based commerce to more online commerce, and that's hospitality sector, property sector, travel sector, lots of legal sector, lots of different sectors. So you're only going to really be putting a sticking plaster on this, and you're still going to see Amazon paying 0.7% of their turnover on rates, and high street business 2.5%. It's simply unfair. I've got to say, in terms of our record, in terms of online sales taxes, we brought one in already, the digital sales services tax. For big businesses, it doesn't actually apply to Amazon's own products it sells on Amazon. It only applies to the merchants, it's third-party merchants. So how is that level in the playing field anyway? It's supposed to hit Amazon's corporation tax. It doesn't pay any corporation tax. So whether this will actually level the playing field using the online sales tax, I'm pretty skeptical, and it certainly won't do to the level we need. So I think really the online sales tax is the current system with some tweaks, and I would much rather see more fundamental reform. I say my idea is to add 3p to VAT, lower the VAT threshold anyway from 85,000, which is one of the highest in the Western world. James is 20,000, because that's another barrier to grow for companies. Get more people. Everybody's paying the same amount in terms of VAT, which is the consumer really anyway, but that's what happens even in business rates. Consumers pay business rates, it's not businesses, it's because profits are eroded away to the level of the cost of capital. So it's, if you've got a competitive market, it'll always be consumers that pay this stuff, but at least you set a fair and level playing field, and then the whole marketplace can decide whether they want to trade from a high street, which I can see the advantages of doing that, or they want to trade online, so and see the advantages of doing that, or a combination of both. But the business, the only calculation there you're thinking is, do I want to pay the rent for a high street premises? And so I think that's a much better way to do it. It's much fairer and more level playing field. Good support from parliamentarians. It needs a proper debate, if nothing else, rather than thinking we'll just push ahead with this online sales tax. But I think otherwise we're going to be left with a status quo for some time.
Thanks, Kevin. Jerry, do you want to make a point about non-retail there?
Yeah, just to say, whilst I fully appreciate the focus on retail because of the challenges retail is facing, business rates are a concern well outside of the retail sector as well. I mean, Kevin will remember the evidence I gave when he was a member of the Treasury Select Committee inquiry, 2019, of one of our major car manufacturers. They occupied 9% of their European footplate in the UK, in England, but they paid 61% of all property taxes in Europe in the UK. That showed how out of kilter it was, and therefore, how much we were disincentivizing, businesses operating within this country. And the same applies to other sectors as well. I mean, we all know the difficulties that offices are going through and probably will go through, and the change that will face the office sector when we return to new normal, which will include much less demand for fully occupied office space in the same way as we have. And so the business rate needs to come down significantly for all. There may be an additional special case for retail, but I think to a large extent, the value of occupation to a business is reflected in its current market rental value. And as long as we had those values updated frequently, we would find retail rental values, therefore rateable values, falling significantly. And an obvious example, the distribution sector, we would see some big increases in their property rental values and therefore the rates they paid. As long as we didn't have this fiscal neutrality, we had a fixed UBR and everybody paid the same proportion of their property's rental value annually updated.
Thanks, Jerry. No, I think that's a really important point to make, which is that the way that we use space as an economy, as a society, is constantly changing, and it's absolutely critical that the tax system keeps up to date with that and is well equipped to reflect those changes. We're running up against time, so as a closing remarks, I just wanted to ask all of you to imagine that it is now 2025, the fundamental review has come and gone. What, if anything, has changed? And Vivian, I'll come to you first, if that's okay.
Okay, well, I'm the eternal optimist, Jan. So I would say the fundamental review did conclude this year, and the conclusion was that the rate should be reduced and the system should be modernised dramatically and should be simplified. And as a result of that, we saw reinvestment in our town centres, we saw employment in our high streets, we saw communities benefiting from dynamic locations, and the government was congratulated for its far-sightedness in finally tackling this issue.
Thank you, Vivian. Thank you. I'll move on to David, Jerry, John, and then maybe wrap up with Kevin, if that's okay.
Okay. Well, I think putting the more radical solutions to one side, let's assume we're still working with the existing system. Then I think what I'd like to see out of this review is the actual system being allowed to work. And I think one of the key elements of that is having an evaluation office agency which is able to administer the existing system in a way which allows the system to work. And obviously it's welcome to see the additional investment coming into that, but it's how that's going to be put through to see those improvements. For businesses, we need to see certainty a lot quicker. The existing system down, I would say, to the under-resourcing of the VOA, that means it takes years for a business to really understand what its rates liability is or should be. Just can't be right in the world we're in today. So if we can move towards more frequent revaluations and get the system back to a basis that is based on current rental values through more frequent revaluations and a system which is administered properly, then that will be my wish list in the next 4 years.
Thanks, David. Jerry?
Yeah, well, I very much hope to have retired by 2025, but I have left for my successors my media statement for 2025, and it says that a business is really pleased that the new government has committed to a review of business rates. It can no longer continue to kick the problem into the long grass, and radical reform is required now.
Excellent. Thank you, John.
Well, I feel that there is just an acknowledgement within the Treasury that For the retail sector alone, the status quo can't continue because it's doing more damage than it's doing good. And they'll lose that income whichever way you look at it. And they have to do something about retail. I just don't think they know what to do about retail, I think is what I'd say. You think the obvious way forward is what Kevin is proposing, that you tax the turnover where that turnover is made. It feels straightforward enough, but it feels like a big jump from where we're at now. That's why I come down to, will there be some sort of hybrid system between the two, where there's a bit of a business rates at the bottom, but it's much more affordable, but actually you're paying the value of the property. You're paying for the value that you make from the property, not from what the property is perceived to be. But we could all be sitting here, we're looking at another review. That's easily possible.
Thanks, John. Kevin?
Yeah, thanks. Yeah, I think I'll tell you what I think will happen, and then I'll finish with what I hope will happen. But I think we'll get an online sales tax probably introduced next year. I think they'll probably move to annual revaluations, which we would all think is a good idea. And there'll be a retail multiplier, which will be different. And I think that's probably the least worst option and the least controversial option I think the government can come forward with. I hope what I'd much rather see is the government simply say, in the 2024 election, we're going to campaign to scrap business rates, stick it on VAT and make it a really fair and level playing field for business, which I think would be great for business and be great for consumers.
Thanks. And on that note, thank you all very much for tuning in today. Thank you again to our speakers for taking part. Have a lovely rest of the week and a great weekend when it comes. Thanks very much. Bye-bye.